The Little Book of Common Sense Investing by John C. Bogle. This work has been widely acclaimed as a foundational guide to investing, emphasizing simplicity, discipline, and the power of low-cost index investing. Introduction. The Power of Common Sense. John C. Bogle, the founder of Vanguard and the creator of the first index mutual fund, introduces readers to the philosophy that underpins his book. Successful investing does not require complexity or speculation. Instead, it rests on the foundational principle of owning the total market through low-cost index funds. Bogle contrasts this approach with speculative strategies, which often result in underperformance due to excessive costs, frequent trading, and emotional decision-making. Key idea: don't look for the needle in the haystack, just buy the haystack. Chapter 1. A Parable, the Goat-Rocks. Family Bogle uses the parable of the Goat-Rocks family to illustrate how investors often lose wealth by paying intermediaries, managers, advisors, and brokers. The Goat-Rocks family owns the entire stock market and collects all its earnings. But as they hire helpers to try to beat the market, fees and costs eat into their returns, leaving them poorer. The lesson is clear. Investors should avoid unnecessary costs and focus on owning the entire market through index funds. By minimizing fees and taxes, they can retain more of their returns. Chapter 2. Rational Exuberance. This chapter explores how stock market returns are composed of two elements: investment returns, dividends and earnings growth; speculative returns, changes in price to earnings, PE, ratios driven by investor sentiment. Bogle argues that speculative returns are unpredictable and often lead to booms and busts. In contrast, investment returns are more stable and dependable. Long-term investors should focus on the latter while ignoring short-term market noise. Chapter 3. Cast your lot with business. Investors should view stocks as ownership in businesses rather than mere trading vehicles. Over time, the collective performance of businesses determines market returns. By owning a diversified portfolio of all major companies via an index fund, investors can share in the economy's long-term growth without the need to pick individual stocks or time the market. Chapter 4. How most investors turn a winner's game into a loser's game. While the stock market has historically generated strong returns, many investors underperform due to high fees, frequent trading, emotional reactions to market volatility. Bogle emphasizes the importance of staying the course and not letting fear or greed dictate investment decisions. Investors who chase hot trends or panic during downturns often lock in losses and miss future recoveries. Chapter 5. The Grand Illusion. Bogle debunks the myth that active fund managers consistently outperform the market. He presents data showing that most actively managed funds fail to beat their benchmarks over the long term due to high expense ratios, frequent portfolio turnover, poor timing decisions. He advises investors to avoid active funds and instead invest in low-cost index funds that mirror the market's performance. Chapter 6. Taxes or costs. Beyond fees, taxes are another significant drag on investor returns. All actively managed funds often generate higher taxable distributions due to frequent trading. Index funds, by contrast, are more tax efficient because they have lower turnover. Bogle suggests that tax-conscious investors prioritize index funds and, where possible, use tax-advantaged accounts like IRAs or 401(k)s. Chapter 7. When the good times no longer roll. Bogle warns that market returns in the future may not match the high returns of the past due to slower economic growth, lower dividend yields, and high stock valuations. In such an environment, keeping costs low becomes even more critical for achieving satisfactory net returns. Chapter 8. Selecting long-term winners. This chapter highlights the difficulty of identifying winning stocks or mutual funds in advance. Even professional fund managers struggle to consistently pick winners. Bogle underscores the randomness of short-term outcomes and the futility of chasing past performance. The solution? Own the entire market through an index fund, ensuring exposure to all winners without the risk of missing out. Chapter 9. The Relentless Rules of Humble Arithmetic. Bogle's humble arithmetic shows that investment returns, what the market delivers, and investor returns, what investors actually earn, are two different things. The gap arises from costs like fees, trading expenses, and taxes. By eliminating these costs, index fund investors can capture nearly the full market return. Chapter 10. Focus on the lowest cost funds. Costs matter. Bogle repeatedly drives this point home. Every dollar spent on fees is a dollar that doesn't grow through compounding. He advises investors to prioritize funds with low expense ratios, low turnover rates, transparent, straightforward structures. Index funds, especially those from providers like Vanguard, excel in these areas. Chapter 11. Index funds that promise to beat the market. Bogle critiques enhanced index funds and factor-based strategies that claim to outperform the market. While these funds may have appealing narratives, they often come with higher costs and increased complexity. True indexing means owning the entire market, not trying to outsmart it. Chapter 12. The ultimate irony. Bogle notes the irony that while active managers collectively underperform the market due to costs, they are essential for price discovery and market efficiency. However, individual investors don't need to engage in this competitive game. By indexing, they can benefit from the market's efficiency without incurring the associated costs. Chapter 13. The Investor's Manifesto. The book concludes with a call to action for investors. Keep it simple. Stick to low-cost index funds. Stay the course. Resist the temptation to time the market or chase performance. Focus on long-term goals. Remember that investing is a marathon, not a sprint. Bogle reiterates the core principles of successful investing: discipline, patience, and a focus on costs. Key takeaways: costs are the enemy. High fees and frequent trading erode returns. Embrace simplicity. Index funds outperform most active strategies over time. Stay disciplined. Ignore market noise and stick to your long-term plan. Think long-term. Focus on investment returns, not speculative gains. Conclusion. The Little Book of Common Sense Investing is a timeless guide for individual investors. By advocating for low-cost index funds, John C. Bogle empowers readers to achieve their financial goals without falling prey to the pitfalls of speculative investing or high-cost strategies. His advice is rooted in decades of experience and backed by compelling evidence, making this book an essential resource for anyone seeking to build wealth through investing. Thanks for joining me today. If you found this summary helpful and want to dive deeper into more transformative books, don't forget to hit that subscribe button. Join our community of lifelong learners and stay updated on our latest book summaries and insights. And if you enjoyed this video, give it a thumbs up and share your thoughts in the comments below. What principle from this book resonated with you the most? I'd love to hear from you. Until next time, keep reading and keep growing.